When it comes to trading, getting into a trade is the easy part, but staying in that trade, that's where most traders struggle. Sometimes your stop loss gets hit too early. Sometimes your target never gets reached. It's frustrating, right? If you face this too, then today's video is a must-watch, because I'm going to show you how to set a perfect stop loss using the ATR indicator, so you can stay in your trade with more confidence. So, ATR stands for Average True Range. It's an indicator created by J. Wells Wilder to measure market volatility. Remember, ATR does not show trend direction. It doesn't tell you if the price is going up or down. Instead, it tells you how much the price is moving. It's volatility. Think of ATR as the market speedometer. When ATR is rising, volatility is high. When ATR is falling, volatility is low. Why am I talking about volatility first? Because without knowing volatility, you can't set an accurate stop loss or target. If you place a tight stop loss during high volatility, it will get hit quickly. If you place a big target during low volatility, your trade might never reach it. ATR helps you see the real market conditions so you can adjust your stops and targets correctly. So first, we'll learn how to recognize volatility, and then we'll move on to how to set your stop loss using ATR. Make sure you follow these steps carefully. Step 1. Apply the ATR indicator to your chart. Open TradingView, go to the indicator section, type Average True Range, or just ATR, and select it. Once it's on your chart, you'll see a single line moving up and down below the price chart. When the ATR line is low, it means the market is calm and volatility is low. When the ATR line is high, it means the market is more active and volatility is high. Think of it like a speedometer. A rising ATR often comes before big price moves. A falling ATR usually means consolidation or a quieter period ahead. So before we even talk about stop loss, first recognize volatility using ATR, then apply the stop loss criteria. How to use ATR for stop loss. Here's the important part. ATR does not predict market direction. It only measures volatility. If ATR is high, it doesn't mean the price is going up. It simply means the market is moving a lot. If ATR is low, it doesn't mean the price is falling. It just means the market is moving less. Let's go through an example. In this example, you see the ATR line rising while the market is trending downward. That means volatility is high. On the opposite side, when the ATR line is falling and the market is moving upward, that means volatility is low. When ATR shows high volatility, your risk-reward potential is larger. When ATR shows low volatility, you should place a tighter stop loss and target. Now let's learn how to set the stop loss. Suppose you take a buy trade. The ATR over the last 14 candles shows 1.48. That means the average volatility is 1.48 points. You can place your stop loss 1.48 points below your entry. If 1.48 points feels too large for your risk tolerance, divide it by 2 and set your stop at 0.74 points. On the flip side, suppose you take a sell trade and ATR shows 0.92. You can place your stop loss 0.92 points above your entry. If you want a wider stop, you can multiply that value by 2, so your stop loss becomes 1.84 points above your entry. This method gives you a stop loss based on actual market movement, not guesswork. If you still have questions about ATR or how to set your stop loss, drop them in the comments. I read every single one. And if you're wondering where to place your target, type target in the comments. If I see a lot of people asking for it, I'll make a full video just for you on that topic. If this video helped you, hit the like button. It really helps the channel grow. And subscribe with the bell icon turned on. It truly motivates me to keep creating more videos like this for you. I'll see you in the next video.